What's up, everybody? Jake Blickenstaff coming at you in another Tip Tuesday video. So today I'm going to make a real quick video. I just wanted to touch and talk to you guys about refinancing your mortgage. So you can refinance a primary residence, and you can also do investment properties. I'm not really going to go too deep into the investment property side because there's going to be some different items that you're going to need. But if you have a primary residence, and even with everything that's going on in today's real estate market, you don't really have the desire to sell and go through the process of buying another one, you can take advantage of refinancing your home. And I'm going to go over 8 reasons today why it might be advantageous for you to do so. But if you are thinking about refinancing, some of the things that you're going to need document-wise to actually refinance your house are going to include recent pay stubs if you have a W-2 job, actual W-2s for the last 2 years, tax returns for the last 2 years. You're going to need a copy of your driver's license, mortgage statement on all properties that you own, homeowners insurance for the subject property or the property that you're looking to refinance, and more than likely bank statements. And sometimes, depending on the lender, you'll need bank statements going back for the last 2 months. Now, 8 reasons as to why you should possibly refinance your current house that you're in. If you're wanting to take advantage of a lower interest rate or a lower payment, even with mortgage rates hitting as low as they've ever hit, and they're starting to come back up, they're still lower than they were, a year and a half, 2 years ago, 5 years ago, 10 years ago. So it's definitely an advantage if you wanted to take advantage of some of those low rates right now, depending on where you're at. Do it before the rates rise anymore. So that could also be another reason for you. If you're wanting to reduce or maybe shorten your PMI, and the reason that that's going to be there is if you have like a FHA or a government-backed loan for your home, then most of the times you're going to have PMI on your property, which is going to be up until you have a 20%, put 20% of equity built up in your property. So if your home has increased in value, you have the ability to refinance out of the PMI if there's enough equity there to make up and you have at least 20% there. So if you have rising home equity, just like what I was talking about, you have the ability to refinance that, and you could cash out some of that, do a cash out refinance. Normally with those, once again, I'm not a mortgage lender, but I have done a couple refinances on my own properties, and you're usually going to wind up paying points for each unique circumstance that you have about your loan. So like if it's an investment property, that's a point. Depending on your credit score, that's going to be another point if it's lower or outside of their normal threshold. If it's a cash out refinance, that's probably going to be another point. And usually a point is 1% of whatever the refinanceable or the total loan value is going to be. So getting back to our 8 reasons. Number 6, if you're trying to move away from an ARM, an adjustable rate mortgage, over to a fixed rate, that could be a great opportunity for you as well. If you're looking to reduce your loan terms, or the unfortunate situation where a lot of people wind up getting divorced, you also have the ability to buy out an ex-spouse with refinancing a loan, whatever your situation is. So hopefully that brought some value to you guys. If you have any questions, I got a bunch of mortgage lenders that I work with on a daily basis. I can shoot you over their contact information if you need anything. As always, 404-281-5002. If there's anything in the world I could possibly help you out with real estate wise. Hope you have a great Tuesday.